The tech sector, of course, took a beating in 2022, tumbling more than 30%. 2023 widely expected to be another volatile year. But will there be light at the end of the tunnel? What should investors look to buy back into tech? And that is Brian Sozzi's take today.
Yes, I just want to run through a very simple playbook. If you're watching some of these really eye-popping layoff announcements this week from Salesforce, Amazon, there are probably more coming from big cap tech names in the weeks and months to come. But let's just get a playbook on things you should be looking for before putting money to work in the battered tech space. A couple very simple things here. More job cuts. Before you invest in any tech stocks right now, you would want to see, I think, the company having taken pretty sizable expense cuts just to help improve their profit profile and profit margins, cash flow. And it looks to be a continued slowdown in sales growth, as indicated by the results or the letters put out this week by Salesforce and Amazon. Number two, peak interest rates. And we talked about this with Paul Meeks, longtime tech watcher, yesterday. It's unlikely, even if you do get those you get more job cuts from tech names, without a signal or an indication the Fed is going to just stop raising rates, which may or may not happen until later this year, just given where inflation is, it's unlikely these tech stocks will work as much as many people would think. You have to get a sign that interest rates are going to just level out here or, in fact, come down in 2024 before tech stocks go off to the races. And lastly, too, another factor that Meeks brought up, he would like to see trough earnings per share estimates. And if you look at the estimates right now for the NASDAQ composite companies, they have not peaked. They have only declined, I would argue, very slightly. You can see that chart right there right now. So earnings estimates for tech companies, there's still a lot of hope and belief that tech companies could still deliver this year. And those are, way I'm thinking about it, those are definitely not trough EPS estimates on the street like a Meeks and like other tech watchers would like to see. Overall, before you wade into the water of tech, I do think you need to see all these factors converge, that likely peak interest rates, more job cuts, and trough EPS estimates before really pulling the trigger on some of these names. Best believe a Salesforce and Amazon, I've watched the market reaction to these cost cuts this week, and they're already starting to think about what else can they be doing to please Wall Street.
Right, and not all of them are the same, right? Because you think about tech broadly, but at the same time, coming down to how they're making that revenue and where that margin comes in from. For some of them, it's ad tech. You don't know when those advertising dollars are going to flood back into the market. And for some of them, it's on the more consumer discretionary side. So in consumer discretionary, there's still this divergence between what's a necessity in tech that somebody has to hold in the palm of their hands every single day versus something that's just a luxury and a service that they may tack onto that experience too.
Yeah, of course, you're right, Brad. All these things are company specific in a lot of cases, like Robinhood. They've laid off or fired 23% of their workforce last year. How much deeper can they go before it actually starts to impact their services? For a company like that, I would say it's more important to see signs of revenue reacceleration than signs that they may cut more employees.
Absolutely.